Today's video is going to be a little bit different. You won't find investment advisors on YouTube doing this very often. But what I'm going to do today is I'm actually going to walk you through step by step of how to create an investment portfolio as a retiree. The way you invest in retirement is definitely different from how you invest as you're preparing for retirement. There's other risks that you have to be aware of that just didn't apply when you were still working. Things like your withdrawal rate or how to set the right asset allocation to make sure that your investment strategy makes sense, you're managing potential upside, and you're managing the risks. We're going to do something even a little more unique. I'm going to get into some specific investments that somebody could use as a retiree to build their investment portfolio. These are investments you can look up online and research yourself. I don't have any affiliation with any of these companies, but these are just some broadly well-known investments that somebody could use. I have to say up front, this is not investment advice. So even though I'm going to get into specific investments that somebody could use, this is not necessarily what you should use. I don't know the details of your situation. I'm just a guy on the internet talking about stuff that I know, but most importantly, I don't know the details of your situation. So before you use anything that you see in this video or any other video, frankly, you need to do your own research. And maybe even it would be a good idea to work with a professional, a licensed financial advisor, to make sure that the plan you put together makes sense, take into consideration everything that's unique about your life. Another disclaimer up front, we're gonna look at historical performance. We're gonna see how these investments have done over time, both in the portfolio setting and individually. But just because an investment has done something in the past does not guarantee that it'll do that in the future. So with all that being said, my purpose today is to share with you some good information for this to be education-based, help you understand some broad principles. In service of that, we're going to use some very specific investments to do that, but that's by no means a guarantee or endorsement of these exact investments. So with all that being said, I hope that you learn a lot from this video to help you prepare for retirement. Or if you are a retiree, maybe the discussion today will give you a better understanding of maybe what you could do, or maybe questions to ask yourself or the advisor that you're working with. So with all that in mind, let's jump right into this video. As an investment advisor, I obviously help people. One of my primary responsibilities is to help people create an investment plan to help them achieve their goals, both before retirement and in retirement. And since I specialize in working with people that are in retirement or are looking to retire in the very near future, that's really where I have most of my professional experience. And of course, that's what this video is going to focus on. So to illustrate investment principles, we are going to use a case study. We're going to go back to a case study we've used in the past for Joe and Tracy. They're 60 years old. They've saved $1.5 million for retirement, and they want to retire right away. So their retirement's going to start this year in 2025 if you're watching this video in the future. And we're going to look at very briefly their overall investment, their overall retirement plan, I should say, and then we're going to focus on directly their investment plan. The process is going to be look at from the very first, how much money are they pulling from their portfolio? Then we're going to look at how to come up with the right asset allocation, which by that I mean like the mixture of stocks versus bonds. Then we're going to look at how they can look at adjusting and managing this investment portfolio over time. I'm going to get into some details of specific investments, but like I said in the opening, this is not an endorsement of these investments. This is by no means investment advice for your particular situation. This is really meant to be education-based to give you some good ideas. And of course, even though we're going to look at some past performance, some charts and that sort of thing, just because an investment does something in the past, it does not guarantee it will do that in the future. It's kind of a tricky business as an investment advisor because really what we have to work on is historical information. But it is the case. It's not just a disclaimer to throw out there. It is the fact that just because something has done something in the past does not mean it will do that in the future. And that's why investment plans always need to be monitored and updated to account for changing circumstances. But hopefully we're going to go over principles that I think are core principles that will apply basically in any investment environment. But always, like I said, plans updated and monitored, and this is not investment advice. Did I mention this is not investment advice?
Not financial advice.
Okay, let's get right into this. All right, so the first thing we're looking at when it comes to creating an investment plan is starting with your overall cash flow. We need to set up a distribution rate that's going to make sense over the long term. And so the first thing I want to show you is their cash flow. So first, we're starting their plan with $1.5 million. And we're going to start with a distribution of $11,500 a month. Now, if you look at the distribution rate, that's pretty high. If they were going to do this for their entire retirement, I would not recommend that somebody with a $1.5 million portfolio starts by taking out $11,500 and then continues to take out that same amount for their entire retirement. It's likely not sustainable. But let's look at their cash flow, and there's more information here under the hood to kind of illustrate what's actually going on here. So you can see in the beginning of their retirement, this purple here represents money coming out of the portfolio. And you can see that not all of that is coming from the portfolio. Of the $11,500 a month, most of that is coming from the portfolio, but they do have a small pension of about $1,000 a month that they'll be receiving. Now, as we go through time, you can see that the amount coming out of the portfolio portfolio is going to drop. Right here, it goes from about $11,000 per month, and then it goes to $9,000 per month. And that's because now Tracy is claiming Social Security, so that now reduces the amount that we need to pull from the portfolio to maintain their plan. As we go along here, you can see that once Joe claims Social Security, represented here in yellow, their distribution rate drops significantly. So this does illustrate one important idea. Whatever distribution rate you set for retirement up front is not necessarily the same rate that you'll use for your entire retirement plan, especially when you factor in things like Social Security. If you're delaying Social Security, or you're just retiring before you even claim Social Security, your distribution rate from the portfolio up front is going to be higher than later on once you've claimed Social Security. And you can see that once we get to this point in the future, if we assume their portfolio stayed roughly the same amount, now they're only pulling about $3,500 a month out of a $1.5 million portfolio, which, simple math, that's far more sustainable. And you can see as we go through time, if we factor in cost of living adjustments from their Social Security and their small state pension that Tracy has, eventually they won't even need to pull money out of their portfolio. So even though a distribution rate of about $11,000 per month up front, even though that would not be sustainable over the life of their plan, in their plan it actually makes quite a bit of sense because later on they're just not going to need to pull that much from the portfolio. Okay, well that leads us to the whole idea of asset allocation. What types of investments should we use, or what are the main tools that we have at our disposal as somebody investing in retirement? Broadly speaking, there are two categories of investments that we're going to talk about today. One is stable or kind of safe investments, and you'll hear these referred to as bonds or cash. And second category are equities. Equities refers to ownership in assets. Ownership like shares of company stocks, shares of real estate. These types of investments are where we're going to get growth. So I'm just going to talk about these in the simple terms of stocks and bonds. Now, like I said, there's a lot of detail under the surface of both of these investment categories. This is very broad. We'll get into a little more detail, but that is not, this discussion is not all encompassing of this topic. So with these two investment categories, stocks and bonds, they have different characteristics. They're different tools at your disposal for creating an investment plan. So generally, bonds and cash are much more stable over time. They don't go up and down as much, and you have lower expected returns over time. On the other hand, equities or stocks, they're much more volatile. From any given year, they can go up or down quite a bit, but over long periods of time, historically, stocks have done quite well, giving investors returns that are above the rate of inflation. Now, when I talk about stocks here, I'm not talking about investing in one particular company over another. I'm talking about investing in a broadly diversified investment fund, like an index fund, invested in hundreds or even thousands of companies. And so when I talk about stocks today, that's generally what I'm talking about. That is what I'm talking about. Specifically in this chart, when it talks about equities, we're talking about investing in the S&P 500. We talk about bonds here. This is talking about investing in the Bloomberg Aggregate Index. It's kind of like the S&P 500 for bonds. That's a little simplistic, but it's a broad index that tracks different types of bond investments all together in a single portfolio. And you can't directly invest in these indices, but you can access funds that invest in the underlying securities within these indexes, so you can get pretty close. So these are things called index funds. So what this chart is showing us is it's really illustrating the idea of how you invest. The number one thing to consider for how you invest is when are you going to need the money. So simply put, money that you're going to spend in the next year or two needs to be invested very conservatively. And just for practical purposes, having that money invested in something like a short-term treasury ETF or a money market fund is a great idea. On the flip side, money that you're not going to spend for decades, that should be invested in something broadly diversified and a very growth-oriented stock portfolio, like the S&P 500, and probably some other things attached to that we'll talk about here in a few minutes. To illustrate that point, let's go ahead and look at this chart. So from 1950 up through 2024, the U.S. stock market has averaged something like 10% per year. But in any given one-year period of time, those investments are they're really all over the map. So what this chart shows us right here under 1 year is that looking at the US stock market, this is showing us the range of returns that have happened historically. So there's been 1 year periods of time from 1950 up through 2024 where you would have earned 2% a year. On the flip side, there's also been years where you would have lost 37% in a single year. Now looking at this color, gray, this is represented by bonds, broadly diversified fund of bonds. You would have had years where you would have earned 33% in a year, but also lost 13%. This light blue is a half and half portfolio, half stocks, half bonds. Best 1 year period of time would have been a positive 29% and the worst negative 16. And in green here, this is good old investing in cash, like a money market fund. And your worst 1 year return would have been 0% and your best year would have been 14%. Think back to the 1980s when interest rates were really high. That's when that would have happened. Okay, now looking at this chart, if you needed money in a 1 year period of time, like I said, what would be the best investment category to have that money invested in? Well, if you look at stocks, the range of potential outcomes is extremely volatile. I wouldn't say that if if you put money in stocks and you were going to spend it in a year from now, I don't know that I would call it gambling, but it's certainly pretty speculative. I mean, yeah, the money will probably grow. On average, the market does go up. You have a greater chance of the market going up than going down in a year. But is it guaranteed? No, not at all. And so you have a really high likelihood that you're going to lose money in a particular year. So that probably would not be a good idea. So what is the investment category here that makes sense for spending over that you're going to do in the next year? Well, simple answer is cash, right? Low expected returns, but what we're looking here is we're looking for stability, all right? The last thing we want to have happen is the money that we're going to spend in the next year. Last thing we want that to have happen is for that to drop in value. Imagine you were saving up money for a down payment on a house and you were going to put a down payment on the house in a year from now. How would you feel if that $100,000 or the whatever you have set aside, all of a sudden it dropped by 30%? It'd be pretty devastating, right? So over short periods of time, your opportunity for growth is, that's already passed. When it comes to spending in the near term, that money needs to be set aside in something extremely safe, predictable, maybe earn a couple percent in interest, but ultimately the objective is to keep that money stable. Now, looking at over long periods of time, let's go all the way down this chart to the right to a 20-year rolling period of time. So from 1950 to 2024, looking at stocks here in blue, the worst annual rate of return that somebody would have had investing in a broadly diversified portfolio of stocks was 6% per year, and the best would have been 18. That would have been a great 20-year period of time, but the very worst is 6% per year. Okay, looking over here at the extreme end of cash, the worst would have been a 1% per year, and the best would have been 8% per year. So, looking at this, what is maybe the most appropriate investment category for a long-term investment horizon? Well, I would argue that stocks are the best, would be the best investment mix. Not bonds alone, not cash alone. You could make an argument for a diversified portfolio of stocks and bonds. I would go for that. But broadly speaking, or generally speaking, having more stocks in your portfolio for something you're not going to spend for a long, long time, that's where stocks really shine. That's where you have both the highest probability of a gain and the highest magnitude of a gain, is when you can let that diversified portfolio sit for a long time, going through the ups and downs of the market, and ultimately achieving returns that are going to be net of inflation higher. You're going to get something greater than the rate of inflation, which is how you actually grow your wealth, or as a retiree, preserve your spending, your purchasing power over time. Okay, let's jump back to the retirement plan and let's look at how do we figure out the right mix of stocks and bonds for Joe and Tracy. So looking at Joe and Tracy's plan, the way that I go about figuring out how somebody ought to have their money invested in retirement is I look at their actual spending. There's lots of rules of thumb out there. Like probably the most common rule of thumb that I've seen is something like take your age and subtract that from 100, and that's how much you should have in stocks versus bonds. So if you're 60 years old, you should have, take 100 minus 60 means you should have 40% of your money invested in stocks, 60% invested in bonds. And I think, frankly, that's just a stupid idea. It is an overly simplistic way of creating an investment portfolio. What really matters is not how old you are, but it matters how much money are you spending from your portfolio. So for example, if you were 100 years old and you weren't spending anything from your portfolio, right? You didn't need to take $1 out of it. Do you really need to have 100% of your money invested in bonds? I would argue no, you don't. That's kind of an extreme example here, but kind of illustrates the point. So what I like to do for a retiree is look at how much money are they going to spend, not from the total plan, but from their portfolio for the first 5 years. So looking at this timeline, starting in 2025, we've got $73,600 coming in income. But where is that money coming from? Okay, so some of that money, they're retiring in November this year. So some of that money is coming from their pension, $1,000 a month, and from the portfolio. You can see we have $21,000 coming from a brokerage account and $50,000 coming from the IRA. But are they spending that full $71,000? They're actually not. Of this $50,000, $50,000 is going to be converted into a Roth IRA this year, which means they're not going to spend it. It's literally going to go from one account in their portfolio to another account in their portfolio. So we don't have to worry about this money being invested conservatively. What's actually going to be spent is just the $21,600 this year. So for year one, they're spending $21,600. Okay, in year two, let's take a look. Well, for 2026, out of their portfolio, we have $130,000 coming from the brokerage account and $50,300 coming from the IRA. But again, that $50,300 is actually just going into, it's being converted from a Roth. And you can see here, it's just going into their Roth IRA. They're not spending that money. So we don't have to worry about that. Just have to worry about what's being spent here. So the $130,000. $21,000. So $21,000 in year one, $130,000 for the full calendar year of 2026. We go along here, we'll see this briefly, or we'll see this quickly here. So in 27, again, they're spending $132,000 from the brokerage account, and that $51,000 is being converted to a Roth, so we don't have to worry about that. In 2028, they have $109,000 coming from the brokerage account. The other $52,000 is just being converted to a Roth. In 2029, they have $111,000 coming out of the brokerage account, and in 2030, so for this first 5 years, let's see, 1, 2, 3, 4, 5. Okay, we'll actually just stop right here in 2029. So in 2029, $111,000 coming out of their brokerage account. So essentially what's happening here is for the first 5 years of retirement, they're spending about $500,000 from their brokerage account to be spent, okay? Well, actually, let's go all the way up through 2030, because in 2025, it's really the end of the year. So to get a full 5 years, it's gonna end up being a little over 5 years. We'll go out to 2030. So as we count up everything they're pulling out of the brokerage account from year to year, and finally in 2030, they're pulling out $74,900 from the brokerage account, and then you can see the $92,000 coming out of the IRA. Of that, $54,000 of that is going to a Roth conversion. So really they're spending about $38,000 from the IRA. If you add all of that up for the first 5 years, it turns out to be about $615,000. So what I do is I look at a client and say, all right, what is being spent for the first 5 years? And we need to set aside that money into something conservative. Now, I do this whether I feel really optimistic about stocks or whether I feel pessimistic about the stock market, whatever the case is. Over short periods of time, the stock market is extremely unpredictable, right? Something I like to, think about or even talk about with people is, even if you had perfect information, someone told you exactly what's going to happen in the year to come. Even if you knew exactly what's going to happen with, economically in the world or geopolitically in the world, whatever the case is, you might still not be able to predict what would be the best investment in order to take advantage of that situation. The world is extremely complex, and oftentimes the market moves in ways that we don't expect, even when we have the right information, or even if we're able to predict the information about what's going to happen in that year. So whether you're pessimistic or you're feeling very optimistic about the future, setting aside 5 years of what you're going to spend, what's actually coming out of the portfolio, is a good way to manage risk and gives you enough flexibility where if the market drops, which, every 5 years, the market dropping by 20 plus percent is not unreasonable. I think that's a pretty good expectation to have, that's probably going to happen at least on a 5 year, every 5 years, maybe a little more often, maybe a little less often, but that's a good kind of rule of thumb, if you will. So setting that money aside really helps protect your cash flow. Even if the stock market drops, you have somewhere in your portfolio where you can pull money from without having to sell your stocks at a loss. Okay, so now looking at their $1.5 million portfolio to begin with, we now know their general asset allocation. So if they're going to set aside about $615,000 into bonds and cash or money market, let's do the math on that. That means they're going to start with a portfolio that's about 60-40. Now that just happened to be the case up front, having a 60-40 portfolio, but that's going to be different for everybody depending on your actual cash flow. Now you can see that over time, that asset allocation is going to change, because once we get further along in their plan, they're drawing less from their portfolio and more of their income is coming from guaranteed sources like Social Security. So you can see that in 2031, they're still pulling out about that same amount from the portfolio. We go along here. Once we get to 2031, we're dropping down to about $114,000 coming out of the portfolio. That stays pretty steady, adjusting for inflation. But once we get to a full year of Social Security, now from their what's projected to be about $1.4 million from their portfolio, at that point in time, they're only pulling from the portfolio. You can see we're pulling out $66,000, but of that, $22,000 is going for a Roth conversion. So they're really only spending about $44,000 from the portfolio. And as we go along, that number ends up decreasing over time. They're just not taking that much out of the portfolio. You can see that, they're pulling out about 73, but 43,000 of that is going to a Roth conversion. So really, they're only living off of about $30,000 from the portfolio. And at that time, the portfolio is about 1.9 million. Here we are in the 2040s. So you can see that actually as they go through time, what's kind of counterintuitive is that their asset allocation is going to get a little more aggressive over time as less of their income is dependent on the portfolio. More of that monthly spending, it's coming from things like Social Security and their pension. So they don't rely on the portfolio, you don't need to take out as much, and that's the number one driver of your asset allocation is how much you're spending. Okay, so now that we have an idea of what their asset allocation is going to be in the beginning of retirement, let's look at how a retiree could think about investing that money. How would they divide that up? Okay, so let's jump over to our investment software. So on the screen in front of us, I'm in my investment software called Quanti, and I've put together an example short-term 5-year investment portfolio that somebody could look at that might make sense. So what this has is it has half of the money invested in a broad bond index fund, BND. This is a Vanguard total bond market ETF, and half of the money invested in BIL, which is a spider 1 to 3 month treasury bill ETF. So this is a mixture of the broad bonds index fund and short-term bonds. The idea for this is that we're matching up kind of the duration of the bonds, the length, maturity of those bonds, with the time frame that we're going to be spending that. Now I have to say, with this particular overall portfolio, what we're trying to do is we're not trying to maximize returns here. We're trying to maximize returns. We might invest in other things, but what we're really just trying to do is preserve capital. So you could even get more conservative than this if you wanted by having a higher allocation of short-term treasuries, have a higher allocation of BIL versus BND. So the main risk that you have with BND, I should say, is interest rate. So with bonds, remember, as interest rates in the economy go up, one of the risks you have as a bond investor is that the value of your bonds can go down. So even if the coupon payments, the interest payments you're receiving are guaranteed or are close to guaranteed, right? You're lending to very high quality companies. Even if that's the case, if interest rates in the economy go up, the value of your bond fund can go down. So the way that we protect against that is by having BIL, which is a very short-term bond. You're basically lending money to the federal government over a 3-month period of time, over 90 days. So this money is, from a credit standpoint, it's essentially guaranteed, right? Now the value of the fund can go up and down a little bit, but it's a very, very, very conservative investment. And that's really how you protect against interest rate risk. So this is a very simple way of doing it, but it's something that I think could make sense for a lot of retirees. If you're looking at short-term money that you're going to spend over the next 5 years, I think a portfolio like this could definitely make sense. So as you go along, you can see that how a portfolio like this has performed over the last 10 years. Well, it's averaged about 2% per year, 1.97. Over the last 5 years, it's been 1.3. Over the last 3 years, we've had higher interest rates. So you would have earned a little bit higher rate of return on this over the last, 3 years, about 5%, 5.25%. So like I said, your short-term money, what you're not trying to do, this is not where you're getting growth that you're going to, outdo inflation, etc. This is just where you are trying to maybe earn a little bit of interest. That's fine, but it's really about protecting your purchasing. It's really about protecting the value of the money, because where the growth is coming from in the overall portfolio is on the growth side of things. So now let's look at the growth portion of the portfolio. All right, again, none of this is investment advice, but these are specific investments that you can research on your own. I have no affiliation with these companies, but just to give you kind of an idea of something to look at. So this is an example of a growth portfolio that somebody could consider or look at for their long-term investment goal, retirement. Money they're not planning on spending for till long in the future, at least 5 years into the future, okay? So this portfolio, we're diversifying it across the entire world, essentially. So one thing I don't like to do is try and predict what part of the globe is going to have the best returns. The truth is, I don't know. There's lots of information and analysts that you can look at and research, but I think it makes sense to have a globally diversified portfolio. So what I went ahead and did is for this portfolio, we've got most of the portfolio invested in VOO, which is a Vanguard S&P 500 index fund. Then we have money invested in the developed world. So this is things like investing in companies based out of Canada and Japan and Western Europe, VEA and other index fund. Then we have money invested in the emerging markets. This is think China, the Philippines, India, Mexico, Brazil. Then I've included in here some real estate, some commodities, and some Bitcoin. So like I said, this is not a recommendation. It's not investment advice, but this is an example of a globally diversified, very aggressive portfolio, which is meant for investing over long periods of time. And you can see that there's plenty of times where a portfolio like this, if we back test it and say, how would this portfolio, how would it have done during stock market crashes and that sort of thing? Well, you can see, even though not all these investments were available during these periods of time, this does give us a little bit of a good sense. So like during the financial crisis, a portfolio like this would have dropped by over 40%. Or during COVID-19, it would have dropped by over 33%. So like I said, very volatile portfolio, which is why in order for it to make sense to have a growth-oriented portfolio like this as part of your retirement plan, that only makes sense if you've already thought through how much money you're going to be spending for several years, and you've got that money already invested very conservatively to protect your cash flows so that you're not forced to liquidate a growth-oriented portfolio in a market downturn. Does that make sense? I hope that it does. Okay, so we'll come back and you can see over long periods of time, 3 years, hey, over the last 3 years, market's been great, so no surprise it's done really well, about 24% per year. Over the last year, 18%, year to date, 16.9. So we're recording this video on October 20th. So like I said, now with a growth oriented portfolio, one of the things that I see, a mistake that I see retirees do is either investing too conservatively or too aggressively. I've seen it before. I've talked with lots of people where they're close to retirement or they're in retirement and they're like, wow, if I could make 15% per year, I'll be able to spend, you know, the amount that I want. Now, the problem is it possible to earn 15% in a given year invested in the stock market? Yes, that's certainly possible. But if you make that your plan, if you have to earn 15% per year for, you know, to hit your spending goals, I guarantee, I can never guarantee anything as an investment advisor, but basically guarantee that that plan is not going to work, okay? Because although it's technically possible, what is likely, it is not likely. That is not likely to happen, okay? So first step of having an retirement investment plan is making sure that your distribution and your withdrawal rate is realistic given very conservative and realistic investment returns. Then from there, you can build an investment plan that lines up with your cash flows in retirement. So hopefully this video has been very helpful and informational. We've gone into some broad concepts about how you can go about creating your asset allocation in retirement. And we've also gotten to some specifics, even looking at some specific funds for how you could go about building an investment plan based on your cash flows in retirement. And I have to stress again, this video is not investment advice. So please don't go and just buy these investments and sail off into the wind. I don't know. I can't give you investment advice because I don't know the particulars of your situation. I don't know how much you should probably have in safe investments or how much you should have in aggressive investments. And so I'm not just saying this, you know, for legalese. I mean, I'm being very serious. I don't know your situation. So I can't tell you how you ought to invest. So hopefully this education-based video has given you a good idea of some broad ideas that can help you as you think about what might make sense for your particular situation. Now, if you would like some help going through your situation, helping you put together an investment strategy for your retirement, I'd be happy to sit down one-on-one, get to know you and understand your situation to help you accomplish that. If you'd like to talk with me, go ahead and click the link in the description and find a time on my calendar. But otherwise, I really hope you have a great week, and I hope the video has provided you with some information that maybe you didn't know before. So until next time, you have a great week.